For weeks, India's benchmark index kept stalling near one number, 24,000. On July 1st, the Nifty closed just below it, around 23,866. Then on July 2nd, it punched through, rising 0.71% to close at 24,175. Nothing about a round number should matter. The companies in the index don't earn more because a line on a chart has 3 zeros in it. And yet, across markets and across decades, prices visibly hesitate, stall, and cluster around round levels. That is not superstition. There is real machinery behind it, orders, options, and hedging flows that concentrate at round numbers. This video opens up that machinery. Why care about this? Because levels like 24,000 dominate market commentary in India. Every morning, Note names them. Every headline tracks them. If you don't know what actually happens at these levels, the commentary sounds like astrology. If you do, you gain a useful lens. So-called support and resistance are partly self-made, created by where market participants have placed their orders and their option bets, not by anything fundamental about the economy. Once you see levels as concentrations of positioning rather than magic lines, you can read the daily fight around them for what it is, a map of where the crowd is standing. Here is how that crowd forms. Two crowds gather at a round level. The first is ordinary investors and traders who anchor on round numbers simply because human minds do. Buy orders collect just below the level, sell orders just above it, and stop losses cluster right around it. The second crowd is the options market. India runs one of the most active index options markets in the world, and option activity concentrates heavily at round number strikes, 24,000 being a natural magnet. Option writers, who sell those contracts, have real money at stake in where the index finishes relative to that strike. So a round number becomes a place where psychological anchoring and financial positioning pile up on top of each other. That pile-up is what turns an arbitrary number into a battleground. Now the mechanism. When option writers sell contracts at a big strike, they usually hedge by trading the underlying market as the index moves. Near a heavily sold strike, that hedging often works like a shock absorber. As the index drifts above the level, hedgers sell into the move. As it slips below, they buy. The result is that price gets pinned, oscillating around the strike, which is exactly what weeks of stalling near a level can look like. But the same machinery has a second mode. When a decisive move pushes through the level and forces writers to unwind or flip their hedges, the shock absorber becomes an accelerator. The hedging trades start pushing with the move instead of against it. Same participants, same strike, opposite effect. Which mode you get depends on how positioning is arranged. And that is why breaks of a long-defended level often travel further and faster than the news alone would justify. So what finally pushed the index through? Not magic. Macro. Brent crude slipped below $71 a barrel as indirect talks between the US and Iran showed progress, easing worries about India's import bill and inflation. IT stocks staged their best day in 14 months, with Infosys, Tech Mahindra, and TCS leading the index. The Sensex rose 579 points to close above 77,500. In other words, a genuine improvement in the macro picture supplied the force, and the positioning around 24,000 shaped how the move traveled. That is the honest division of labor. News provides the push, structure decides the path. Neither alone explains a day like July 2nd. The takeaway: a round number is not a prophecy, it is a map of positioning. When the index hesitates at a level for weeks, that tells you where hedging flows and anchored orders are concentrated. When it finally moves through, watch whether the level now behaves as a floor, because the same crowd that defended it from below often reforms above it. None of this predicts where the Nifty goes next, and nothing here is a suggestion to trade anything. It is a way to understand why the fight happens where it happens. The forward question: as fresh option positions build around the next round level, does the pinning behavior reappear there? More breakdowns of the machinery under the market are coming. This is educational content, not financial advice.